Welcome, welcome. I just want to say I am so appreciative of what we're going to be talking about today, who I am talking with. And just to get started, this is Lauren Fogelman with Business Success Solution. And today's topic is how to expand your business through acquisition. And I'm going to be meeting with Shannon Hay. We're going to have a discussion around this. But some of the things we're going to cover, just to give you that preview, is to figure out what the market might be willing to pay for your business, or if you are looking to acquire another firm. And also how to be able to understand the value in a firm. And then the last part is we are going to dig into the ins and outs of lending, how to be able to navigate that in order to be able to get the best positioning possible. So I suggest you have pen and paper ready, because Shannon is always very generous with sharing information. And then as we wrap up, we will let you know how you can connect with him and follow up with him. But a little bit about Shannon is he is the senior loan officer with Live Oak Bank. And Live Oak is one of the nation's largest SBA 7A lenders by volume. Shannon has over 30 years of banking, even though he doesn't look like it, and a lot of financial experience. He has worked for several large banking institutions over his career. In 2017, Shannon was recruited by Live Oak Bank. They wanted him to launch their accounting and tax lending program because that he is solely dedicated to accounting firms, understanding how to finance their acquisitions, whether it's on the buy or the sell side of M&As. And then because of that, it gives him a unique perspective about deal structures, evaluations for accounting and tax firms. And the other part is Shannon is a very active presence in the accounting industry. He is at trade shows. I have actually met him in person at conferences, and he speaks on the current market of accounting firms, succession, and acquisition. So if you want to learn more about Shannon and Live Oak Bank, you can go to liveoakbank.com and get all the details there. But Shannon, let's go ahead and dig in about what it is you have to share.
Well, thank you, Lauren. Thank you so much for having me. I really appreciate it. Just excited to be here and excited to share information. It is an exciting time in the accounting industry. There's a lot of movement in the market. So
there is a lot of changes going on. And before we start to really understand how the M&A part works with accounting firms, whether you're on the buy or the sell side, I would love to just hear a little bit more about how you actually ended up being a specialist for firm owners and firm buyers.
Yeah. So I was prior to Live Oak Bank, I was actually with Bank of America. They launched they obviously launched into the market, wanting to do lending into the accounting world. They were already doing doctors and dentists, and then wanted to work their ways into lawyers and accountants. They just saw it as the next progression of professional services lending. And so I was a part of that program launch. And just like any big bank, it expanded really quickly with these great ideas, but then contracted kind of equally as fast. They got really excited and then kind of got a little nervous. What we saw in that process is that SBA lenders really had it figured out, that the SBA government guaranteed lending program allowed for a goodwill transaction, a non-asset based loan model to really exist and thrive. And that's when I kind of recognized, well, there's this wonderful market here working with accountants. They always have their financials in order. They always understand their businesses pretty well, easy to work with. And then SBA, now has, this government guaranteed program that allows banks to really lend into goodwill based transactions. And they just fit together really well for me. And so I got the opportunity to do some SBA lending, learn that program. And then that's when I landed at Live Oak Bank. So.
And one of the things that I found as I talk with accounting firm owners, whether they're looking to acquire a firm to be able to grow their business or they're on the exit side of things, is that value and willingness to pay are complementary, but they're not the same. Can you explain the difference between the two terms and how you can figure that out?
Sure. So, value varies greatly from firm to firm. And it really does matter what kind of service you're providing, how you're providing it, how you're delivering that. And then as well, who you're delivering it to. whether it's geographically, whether it's client type, those all have a great impact on the value of a firm. It's if you're rural, right? So it might not be as desirable as someone that's in Chicago or LA or New York, right? If you're doing a lot more personal tax returns and less business preparation, that might not have as much value. So there's a lot, but all that is really taken into consideration. I always say beauty's in the eye of the beholder, right? And we certainly want to do our best to make our firms as beautiful as possible so that we have more beholders, I guess is a better way to say it. So.
And then what about the other side where we're looking at willingness to pay? That's a little bit of a different mindset that needs to be considered also?
Yeah, I would say that the market is shifting significantly, that most firms nowadays, value is recognized, right, intrinsically. What I always say is that gross revenue minus debt really is your equity value in a business, and it's really a 1-to-1 ratio when you're analyzing it individually or internally. Now, external to market, accounting firms generally start out in the market on like a 1.3 times gross revenue multiple is where they'll list at, and then kind of where they tend to land in my portfolio is about 250 million in accounting firm acquisitions, probably about 350 acquisitions total. The average is a 1.15 multiple of gross.
Got it.
That's national. So we do loans in all 50 states. We do acquisitions in all 50 states. Some of those are in Chicago and some of those are in rural North Carolina, right? It just depends.
Okay, then what I'm hearing is that looking for a 1.3 multiple is where you want to start, but this gives you some room for negotiation, and that on average, you might expect to have the buyout be at a 1.15 multiple. Is that true?
Yeah, no, yeah, that's exactly true. And I would say too that, again, type of work kind of drives that. So business tax returns, bookkeeping, recurring revenue, those tend to drive a higher multiple than personal tax returns, on the individual basis, right?
And that's something that was coming to mind as you were talking about also is, okay, now that you're looking at year-round revenue as opposed to just seasonal, whether it's business tax or personal tax, are there things that firm owners can do to actually start to increase the value in the firm? And are there specific things maybe for geography, like the rural versus someone who is more in the city?
Sure, there's a lot there, a lot to unpack. So, on the increasing value side, the type of work side, right? Recurring revenue is a key element. If you can get some sort of monthly recurring revenue model going within your firm, what I refer to as the value billing model, right? Where you're not necessarily, maybe you have business clients that you're doing quarterlies for, you're doing monthly bookkeeping for, you're doing your annual tax returns for, and you're advising at the same time. That is a client that's going to pay on a monthly basis, right? Generally. And you might be able to work them away from a billable hour, just get them to a flat fee, but paying on a monthly basis via flat fee. That in the market is a highly sought after client, right? And a highly sought after type of firm. So the more types of those clients, the more sought after your firm becomes. On the rural individual side, right? But taking both into consideration, it's really how's the client managed, right? So if you have to use the technology, you have to be able to, because a lot of people aren't going to come to nowhere in North Carolina to buy a firm, right? It's just not appealing to the person that wants to live in Charlotte or Raleigh. And I'm using North Carolina's example because that's where I live. But I can kind of make that reference is that if that outlying firm, say again in Whiteville, North Carolina, right? Great town, great little town, but those clients are used to dropping off that information in person, right? Receiving that information and then see. But if somehow we're able to convert them to some sort of technological onboarding, right, to where they're being managed technologically, where they send it to you digitally, you return the return to them digitally. That's now has value because that firm can be purchased from Raleigh, managed from Raleigh, but still be serviced and still be maintained as a client, still be maintained as revenue. And that is really the big difference. So big encouragement here is if you're an outlier or you're a rural firm, technology is everything to you, right? Because that's going to be the advancement that gets you to the next level, that makes your firm appealing enough to be purchased in the open market.
Okay, then actually what I'm hearing is three things. Recurring revenue is best because it gives you steady cash flow. The
Yes.
next thing is that if you look at how to be able to increase the value of a client, adding in advisory services is something that will go ahead and be a natural way of raising the value as well. And then the third thing I think is the technology, and it's beneficial, especially if you're rural, but it probably has benefits no matter where you live, because it makes you easier to be absorbed into some other company, whether they're local or not.
That's correct. That's correct. Yeah.
And so with that being said, what about the equity in an existing firm?
Sure. I go back to my original model is that I always say it's a 1-to-1 gross, right? When you're thinking about your own existing equity, right? So what was your revenues for the prior year, and then subtract any debt you have on a 1-to-1 basis. So a lot of firms today have EIDL loans, economic injury disaster relief loan, which is, by the way, an SBA program. It is an SBA loan. Great term, 35-year term, with a 3.5% interest rate. So it's really appealing money, when you took it, and even from a lending perspective nowadays. So, but a lot of businesses have those. So I always say 1 times gross minus any debt equals your equity position. And then now the good part is you can leverage that equity into other things, right? Other opportunities.
And I know that that's a really hot topic, and not everybody understands that. So let's kind of talk about the leverage part and how that can be used to expand someone's firm.
Sure. So your existing firm on that 1-to-1 multiple, right? You might have a little debt. So let's say you're a $500,000 firm, $500,000, and you have a $100,000 EIDL loan out there. So now we subtract the EIDL from your gross revenue. We have $400,000 in equity. The SBA requires that you have a 10% equity injection in any transaction. So that means you're open to go to the market with your $400,000 in equity and look at other firms. And you technically have the equity position already that you really wouldn't need to put down cash into a transaction. You could use the equity in your existing firm to leverage and expand and buy an additional firm. Now, what I would say is geography does matter a little bit. We want it to try to be somewhat commutable to your existing firm, or if they're virtual, right? Those are very commutable because it's all done virtually. So we can talk about that. And then really it's just, striking the deal, making sure that NAICS code, right? They have, like, the NAICS code should line up. So 5-4 NAICS code for an accounting firm, 5-4 NAICS for the accounting firm that you're buying. As long as those are all in line, those three things, geography, equity, and NAICS code, we can really do an expansion loan, 7A program, 10-year term. Generally, I like to say single-digit interest rate. They're creeping up there on us. Rates are higher than they were a few years ago, but really can drive into that deal to, maybe even double your firm size or even go larger if you think it might be right.
And Shannon, I know that you are so customer service oriented. Can you share any stories of maybe someone that you worked closely with and help navigate them through this process, and how that made a difference because of the fact that they chose to work with you in Live Oak?
Yeah. So I'm niche, right? And brings up a off subject point here. Niche also matters in value too, right? So if you can show that you're a specialist in your area of expertise, you create value to other specialists in your area of expertise from a firm perspective. So I'm sorry, I just want to throw that point out there. The reason why is because it's relevant to the story I'll tell is I only look at accounting firms all day, every day, right? So I won't try to figure out how to finance a car wash or a restaurant and then look at an accounting firm. What that does for you as a customer of mine is it gives you somebody that has exposure to prior deals, understands deal structure, sees things within that deal that I might be able to make suggestions of to you in your deal. And so it gives you someone that has experience and exposure. So then in turn comes with that is just industry knowledge, industry expertise, and really where I say that my value most lies is in just structure advice, right? We see these types of seller notes, we see these types of escrow agreements. This is the value that we perceive to be the case. We do a third-party business evaluation on most of our transactions. So we do as well have a non-biased party involved, right? That can give us their assessment of the value of firms. But no, I think experience more than anything. What I've done in the past is really it's really all about the expansion, right? So someone starts with one, right? Owns it, operates it, shows that they can manage a firm effectively, has a reasonable income, and then we leverage that equity into another purchase. And we can do this over and over and over again. The SBA 7(a) program has a $5 million runway. So when you think about technology, outsourcing, the variables in accounting, the sort of the roll-up strategy really is a successful opportunity that exists in the market. You have a lot of baby boomers retiring, a lot of firms coming to market, but then a lot of opportunities from a technology and outsourcing perspective that give capacity to manage it. Staffing is the big challenge nowadays, right? So it's really solving for that problem. If you're able to do that, or you have a solution, then you're really prepared to grow exponentially.
And one of the things that I've seen with you, and it's true, it's been my experience also, because like you, I only specialize with accounting and tax firms, is that you also develop relationships with other people that might benefit that firm owner. So do you feel that there's times that you've opened up your Rolodex and made connections that were able to help someone maybe start moving this direction, or even ended up sweetening the deal somehow?
Yeah, well, I specialize in knowing who has the deals, right? So who is in the market trading the deals, right? The brokers or the intermediaries. So I have relationships with virtually all of those individuals, companies and members. I would say overall, there's probably over 50 individual practice brokers nationwide that specialize in selling accounting firms. And then from a company perspective, there's probably 20 or so companies, 25 companies that actually specialize in this. They're all on various listing services, biz, buy, sell, accountingpracticeexchange.com. Having a relationship with an institution that already has a relationship with a broker now lines you up for a position that maybe another buyer might not have, right? Has already talked to a bank, has already somewhat been pre-qualified from a lending perspective, and then now has the capacity to go have that conversation with that broker, and is probably more likely to get an introduction to a seller because they know that this person's somewhat been vetted or been through a process.
Mm-hmm. That's where credibility matters. And one of the things that I was thinking of as you were talking about the roll-up strategy also is that maybe there's a certain threshold where a firm needs to be in order to really be best positioned for this. So how much equity needs to be in a firm if they want to start moving in this direction?
Yeah, I mean, I would say that, any equity matters, right? We generally wait till the $100,000 mark, right, before we say that a firm is a firm and has equity. So there's a lot of accountants out there that what I call the side hustle, right? They might do their friends and family or some small businesses that they know, and maybe they do 50 or 60,000 in tax returns annually. I wouldn't quite call that a firm yet, and I wouldn't quite say that firm has equity. It's really like once you cross that 6-digit number, that the value starts to show up, and then beyond that, it really just we just want it to make sense. We want it to be logical. It probably isn't. It probably isn't logical for someone that's managing a $400,000 firm to immediately go buy a $4 million firm, right? That there should be some incremental growth in that. But what I would say is the owner of a $400,000 firm should, by all means, get excited about buying another $400,000 firm because they've already proven that they have the ability to do that. And if the $400,000 firm they're looking at is profitable and fits well, meshes well, merges well, because what happens when you have two firms that come together is that then now you create all these efficiencies of scale, right? Whether it's software or lease, or maybe it's even some staff overflow. Maybe there's a process that exists in the firm that you're buying that you've always wanted to have in your firm that you've never really implemented that could be of cost savings to you going forward. There's a lot of variabilities there that can be extremely beneficial from bringing two firms together.
And as we're getting ready to move into this process, how exactly does lending with the SBA program work?
Yeah, it gets a little bit of it has a little bit of a negative connotation because just like anything government, it does have, a little red tape around it. what I would say is that working with a preferred lending provider like Live Oak Bank can really make a difference in the pain points of that process. Practice makes perfect, right? Or repetition just creates efficiency. Generally I always say that our goal is 45 days, right? But the average is 60. What do I mean by that? That when we enter into starting on a project, letter of intent is really our trigger point. Then through application, we generally want to be able to try to close that within a 45-day window. That's the goal. But the average is 60 because there's things that just get tied up in the process that tend to drag it out further. Asset purchase agreement, leases, life insurance, different types of, there's just different things that are variables that we want to make sure they're in place to protect you as a buyer borrower, and to protect the seller as well to some regard, that are done a little bit with a fine tooth comb. Operating agreements, if there's partnership agreements, so on, so on and so forth. It can get there's a little minutia in a deal, right? Again, I think experience matters, right? Having somebody that's seen these types of transactions can really, really change the process or the pain points within the process for you. So.
Okay, so we're talking about 45 to 60 days as the time to be able to go, to be able to finally close the sale and complete the transaction. But I know we're talking about the government and things change on a regular basis.
Yes, they do.
Nothing ever remains the same. So change is constant. Any changes in the SBA program that really would be relevant and something to consider?
Yeah, that's a very, very hot topic right now. And it's exciting for me as being an accounting specific lender. Major change in the SBA program is before this most recent implementation, a seller wasn't allowed to retain ownership in their firm. So if I was a seller, I had to sell you all of it or none of it, right? So, and as an SBA lender, I could only loan in situations where 100% of the firm was trading hands. As of recent, they're now allowing for sellers to retain ownership and sell majority or part of their firm. And what this does is it changes everything from an acquisition perspective in the accounting industry, because now a seller, if they retain ownership, can stay on greater than 1 year, where before they weren't allowed, they had to actually exit within 1 year. They couldn't be in a key management role greater than 12 months from the date of acquisition. Now they're able to they can stay in an advisor type role. We still want to try to pull them away from that key man role, because if we're financing the acquisition of goodwill, we want to make sure that there is a transition of goodwill in some way. But that certainly means that they can stay on an advisor type role or a business development role, consultant type role. That is all very much allowable. And then as well, I think makes changes in, still trying to figure out that this is viable or not. But my belief is because of that retained ownership, now you don't have some of the kind of the CPA rules that notification of client transfer. You have to change the name if the owner's name, the owner's name can't stay in if the owner's not there. Type of scenarios. I think those are things we can kind of work around in the accounting world that the SBA might have caused some headaches for in the past. And it really has opened up, I think, for accounting some big opportunities to work more collectively with buyers and sellers, and they can be more. It's not as staunch as it used to be. One of the other major changes too is that sellers can now participate a different way in a buyer's equity. So, say you're a first-time buyer and you want to buy a firm for the first time. Now, a seller has greater opportunity to participate in your buy-in. So.
Excellent. And so something that I really hear about what you're talking about is that they change the dynamics of the handoff, and that it really is very highly aligned now with client-centered firms where the principal might have had some relationship with some of the key clients there, and they're worried about that transition and possibly clients moving on. And because the fact that the seller can now retain that ownership and stay on for a greater role in some way, advisory maybe or consulting, it eases that transition to where that value or that book of business is more likely to be retained over time. Is that how that has been working out, Shannon?
Yeah, well, in the past it was you had 1 year, right? So it was to really get the buyer had to really get in front of that seller's client and really build that relationship. Sometimes that the relationships don't work that way, right? It takes a little longer than a year to build a strong relationship. And so now what it allows is that if a seller feels that it's going to take longer, that they're able to retain a portion of ownership in the firm and then continue that relationship, continue massaging it, managing it, and transitioning. That's basically it's succession, right?
Mhm.
But in a not a rip the Band-Aid kind of way, a very methodical, well thought out and client centric kind of way. So
Nice, nice. So Shannon, I always learn something new from you. You made some powerful points. What we touched on today was figuring out what the market's willing to pay, how to be able to understand the value in your firm, the ins and outs of lending, rural advantages versus in the city. And if somebody wanted to reach out, find out more about expanding their firm through acquisition, what's the best way for them to connect with you?
well, I'm on all the social sites, right? So I'm going to be on LinkedIn. You'll find me there. Really, always growing my network on LinkedIn, obviously. So please connect with me there. I'm also on Twitter at Shannon Hay LOB. My email is really easy. It's my first and last name, shannon.hay@liveoak.bank. Open to everyone. Please email me. And then I'm brave enough to give my cell phone. It's 614-648-9199. And my phone is always open.
And he does answer the phone. I've called him without it being scheduled periodically. So he is very, very accessible. Shannon, thank you so much for this engaging conversation and everybody that has joined us. This is Lauren Fogelman with Business Success Solution, showing accounting professionals how to double their income working half the time.